Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial report of ClearBridge Variable Mid-Cap Portfolio, and trust me, it's more exciting than it sounds, well, hopefully. It's like watching a financial roller coaster, some thrilling climbs, a few unexpected dips, but hopefully no one gets motion sickness. So what's the story here? This report gives us a peek into how well ClearBridge's investment strategies worked over the past year. Were they hitting home runs or striking out? Let's find out. First off, this isn't your typical company, but a portfolio or collection of investments within a larger fund. Think of it like a curated basket of stocks, aiming for growth in the mid-sized company range. For the year that just ended, the portfolio's Class I shares delivered a return of 10.01%. Not bad, right? But hold on, because the report also mentions the Russell Midcap Index, a benchmark they use to measure their performance. That index returned 15.34% during the same period. This means that the portfolio underperformed the index by a meaningful amount. That's a good starting point for figuring out the story here. Let's keep going and find out why. So what worked and what didn't? Let's start with the winners. These are companies that helped boost the portfolio's returns. The report highlights AppLovin, Marvell Technology, and Vertiv as top contributors. AppLovin, with its software platform for mobile app marketing, saw robust growth thanks to its AI targeting engine. Marvell Technology, a semiconductor company, got a boost from investor enthusiasm for its AI-driven growth. And Vertiv, which makes infrastructure for data centers, benefited from strong data center demand and effective cost management. Now for the not-so-good news, here are the detractors. These are the companies that dragged down the portfolio's performance. Atcore, Five Below, and Freshworks are mentioned in the report. Atcore, which makes electrical products, suffered from weaker order volumes and higher material costs. Five Below, a value retailer, was hit by rising costs and what they called elevated shrink, probably meaning theft. Finally, Freshworks, a software company, saw its share price decline as investors worried it was losing out on the AI boom. Okay, let's take a long-term look at performance. The report includes a graph showing the value of a hypothetical $10,000 investment over the past 10 years. It helps to get a sense of how things are trending. Over the last 10 years, Class I shares had an average annual return of 7.29%. For context, the Russell 3000 Index, a broader market measure, had an average annual return of 12.55%, and the Russell Midcap Index had a return of 9.63%. Again, ClearBridge underperformed the index by a meaningful amount. This longer-term view is helpful to keep in mind, and it's important to remember that past performance doesn't guarantee future success. Now let's scroll down to some key numbers. Total net assets that are managed are about $272 million. Keep in mind, this is a snapshot as of the end of the year. The total management fee that was paid was roughly $2 million. Another important metric is the portfolio turnover rate, which is 35%. This tells you how actively the portfolio manager is buying and selling investments. A higher turnover rate can mean higher transaction costs. Looking at what the fund actually invests in, most of the investments are in industrials, information technology, and financials, but it depends on the time. This tells you where the portfolio is placing its bets. Let's talk about expenses. For Class I shares, the costs are about $85 for every $10,000 invested, or 0.81%. For Class II shares, it's $111 per $10,000, or 1.06%. This is important to consider when evaluating the overall returns. Switching gears, the report confirms they have a code of ethics in place for their top executives. This is standard practice, but it's always good to see that they're committed to ethical conduct. The report also breaks down the fees paid to their accounting firm. In the most recent year, audit fees were around $379,000, and tax fees were another $149,000. There are pre-approval rules in place for non-audit services to ensure the auditors remain independent. The audit committee responsible for overseeing the financial reporting process includes several independent board members. This helps ensure that the financial statements are reliable and transparent. So, what's my take on all this? ClearBridge Variable Mid-Cap Portfolio has some strengths, but there are weaknesses. The portfolio's recent underperformance compared to its benchmark is concerning, especially given that the portfolio underperformed both over the year and over the last 10 years. While individual stock picks can be unpredictable, consistent underperformance may indicate issues with the investment strategy, particularly as the top performing companies didn't outperform enough to cover for the underperforming companies. That said, it's good to see that the portfolio is invested in areas poised for potential future growth. One notable opportunity for ClearBridge could be to really narrow the focus on a particular subsegment of the market. By focusing on a particular sector, they could possibly leverage their expertise better since they haven't been able to compete with the index. Overall, is this the best option in the market? Seems unlikely based on the numbers. The team will need to prove that they can actually generate returns for investors to be seriously considered. Thanks for watching. If you found this deep dive helpful, please like, comment, and subscribe for more corporate decoder videos. Let me know what company you'd like me to cover next.